This is Mindy Strong. If you are studying for the Series 65, this is the section on life insurance, and I want to give a special shout out to Bobby. You got this, girl. Okay, here we go, y'all. Life insurance. Okay, first of all, we have fixed annuities. Fixed annuities have a guaranteed rate of return. Generally, that guarantee is lower. So think in terms of like 2%. So they'll say to you, listen, you put your money in this account and it's guaranteed to grow at a rate of 2%. Now, the market might go crazy and do really well. The market might go horribly wrong. Doesn't matter to you. You have a fixed annuity. You know you're getting 2% on your money. The insurance company, therefore, has all the risk. If the market goes down, that's their risk. The insurance company also assumes the mortality risk and the expense risk. The annuitant assumes the inflation risk. So again, let's say they're making 2% and inflation goes up 3%. Oh, you're not making money on your money. So I have the arrow here for the percent. That is what we are looking at with the guaranteed rate of return. There's two types. It can be period certain or it can be to perpetuity. Perpetuity means forever. Period certain means for a period of time. We are guaranteeing this rate to you. Then we have variable annuities. So a variable annuity has no guaranteed rate of return. The investor assumes the investment risk. Generally, a trust is created for these, and there's a separate account that buys shares. Therefore, variable payments will be made through that account. Often these have a bonus, which is an incentive to buy it. You transfer your money over into this annuity, we're going to give you a bonus of 5% on your money, as an example. Now, if we were looking at this graph and it was comparing fixed annuities and variable, then the line for fixed would be a little bit closer here to 0. But this is your fixed annuity versus your variable annuity. Okay. Now, there is an assumed interest rate and example only when it's annuitized. What I mean by that is they'll give you a prospectus and they'll say, okay, look, if your money grows at, say, 5% a year, this is what it's going to look like in 2 years, 3 years, 4 years, 5 years. It's an assumed interest rate. It's only an example. The real interest rate is set when you annuitize it. Sometimes that number is going to be better than the assumed interest rate. Sometimes it's not going to be as great. So when selling a variable annuity, they have to be clear to say, listen, this is an assumed interest rate. Your interest rate is probably going to be a little bit different than this. These have mandatory reinvestments, so you have to reinvest. They are doing this for you, reinvesting any profits made. But the good news is these are all tax deferred. So until they annuitize it, they don't have to worry about that growth and the taxes. Okay. Now there are different payment options for variable annuities. If you have a life annuity, so when you annuitize, you're basically saying, okay, this is what we are going to give you. We're going to lock it in and we are guaranteeing you this. Now, if you have a life annuity, then they are guaranteeing that they will pay you for the rest of your life. What that means is, let's say you're 60 years old and you go, oh, lock that in. I think I'm going to live for a long time. If you die a year later, guess what? Those payments go away. So it's a risk. All of these involve risk. But the life annuity is going to have the highest payout of all of these options. Then we have something called the life annuity with period certain period of time. So they say, listen, okay, you're not quite as risky. Here's what we'll do. We promise that we are going to pay this monthly amount for the annuity out for the next 10 years. If you die or not, for 10 years. Now, that means that if you outlive that and you live longer than 10 years, they wipe their hands of you and your payments go away. But if you die a year from then, your family still gets 9 more years. So that is a life annuity with period certain. Okay. Joint and last survivor. This covers 2 lives. So in this case, they say, listen, we know that you guys want a guaranteed paycheck until you both pass away. Obviously, this is going to pay out less because it has to continue for the remainder of both people's lives until both people have passed away. And then there is something called a unit refund life, and that states that if there's any money left in your account when you pass away after these annuitized payments come out, the estate is going to get the balance. Okay? There are advantages and disadvantages to all of these. This is just risk. Okay? Now you also have lump sum options. These are designated for a period of time. Again, the owner may outlive it. So you go, listen, okay, we're locking it in right now, and we will give you this money over the next 5 years. We're going to pay this out to you. What if that person dies in a year? Well, same idea here, a designated amount. So in this case, they say, okay, we will give you this amount monthly for this until it runs out. So it might be that you drain the account, you outlive that, and done. These all involve different types of risk, but these are the lump sum options as opposed to the payment. And again, this is a tax-deferred vehicle. So once these payments start coming out, then you have to pay taxes on them. Okay, equity indexed annuities. So the returns are going to be tied to an index. There will be a minimum guaranteed, but it's generally going to be lower than the fixed annuity guarantee. Let's think about that logically. If the fix says, hey, we're willing to give you 2% no matter what, and the equity index says, hey, we're willing to give you 3% no matter what, and you could get more, nobody would ever buy a fixed annuity, right? So this minimum guarantee is going to be at like 1%. It's going to be very, very low. However, you have the ability to earn more. Now, there is something called the participation rate. This is the percentage of gain that you get to participate in. And I gave you an example here. First of all, let's acknowledge the cap in the room. We've got a cap and we have a floor. That's because I'm dorky and I want to give you the idea that there is a floor, there is a minimum. The minimum guarantee generally around 1%, and then we have our cap. In this example, we're going to use 9%. So here's the example I want to lay out for you. Let's say that you have an equity indexed annuity that is indexed with the S&P 500, okay? And let's say the S&P 500 increases by 20%. Wow, that's awesome. You have a 75% participation rate in this example. That means, and it's capped at 9%, okay? That means that you get to earn 75% of that 20% increase. Do the math, that's 15%. So you get to take advantage of 15% of that. Hold on, but you are capped at 9%. So in this example, you would receive 9%. Now, let's say this gain, these numbers are different, and this gain is less than 9%, then that is how much you would receive. But the cap, the most you will receive in this example is 9%. Okay. There are ways that the index can be measured and therefore money can be credited to you. There's point to point. That means, let's say you have a 7-year annuity. They say, okay, March 30th, you took out this annuity. 7 years later, March 30th, they look at the difference in the S&P 500 and they say, all right, it went up 5% points. 10% points over that time, that is the interest you would be credited. Then there is the annual reset. Each year, the interest is added and there is a compounding effect. So again, they take date to date and they say, okay, what was it when you started? The anniversary went up 2%. You get a credit of 2%. Your new balance now includes that 2%. And then the next year, you're going to get the credit based on that new balance in your account. That is compounding interest. There is something called a high watermark. At the end of those 7 years, they look at each March 30th and they go, okay, which one of these had the highest interest rate? It was 15% on this date. Well, you're capped at 9, but okay. That is the interest that you will get. And this should be noted. There are higher expenses and surrender fees associated with these rather than fixed or variable. Why? Listen to all the work I just had to do. They have to go back and look and decide what your interest payments are going to be, and they have to control it, because remember here, they are making sure that they don't lose any money, because you're not losing any money. They put the floor in there, didn't they? So it's going to be more expensive for them because they have to get in and out of deals to save money. Make sense? So there are higher expenses involved in this. And also they want you to stay, so they have surrender fees associated with leaving early. Okay, now let's look at life insurance. So first we're going to talk about term. Essentially, this is your pure insurance with no cash value. Wow. This is to make sure that you're paying attention. Non-renewable after a certain age, and they can have increasing periods. So term, for a period of time. Okay? These are going to be less expensive than whole life. Whole life is going to have higher premiums, but they're level. There's going to be a cash value in the general account, and this is permanent. This is going to last for your whole life, also called final expense, also called permanent. All the same thing. Okay, here we go. Universal life. These have two aspects that are flexible. The premium and the death benefit are both flexible, just like those two people there. The minimum payment is set. There is an excess over. If there's an excess over, it goes into the general account for universal life, and then you can use it later to decrease your payments. Variable life is permanent insurance with a cash value account that is separate. The premium here is fixed, the death benefit is fixed, but the death benefit can increase over and above that fixed minimum based on the performance of the separate account. So the actual payments, once you annuitize it, can vary. That's where the variable comes in. The payments can vary over and above what you were guaranteed based on how that separate account does. And then there is sort of a marriage between the two. There is a variable universal life. So it combines some aspects of variable and some aspects of universal. Excess premiums are put into a separate account, like variable. The premium payments are flexible within limits, like universal. And like variable, there is minimum coverage that is guaranteed. Okay. Viatical settlements. These are not very common, but I do want to mention them. Think back to the 1980s with the AIDS epidemic. We had a lot of young, healthy people that had insurance policies, and they were dying within a short amount of time. So they decided to let people sell their policies. in order to get cash. So this is the idea that you can sell your policy to someone else. The buyer of the policy is called the Viatical Settlement Provider. The seller is the viator. I guess that's how you say it. The seller gets cash for selling the policy, and they transfer the policy to someone else. Obviously, the cash they get is going to be lower than the value of the policy, but they can get some cash for it. The buyer of that policy then takes over the premiums. They start paying the policy premiums, and they get the death benefit when the seller dies. Now, the return on that, how much they get, is determined by how long the person lives. And this is where it really gets kind of drab. The shorter amount of time the person lives, the sooner the person dies, the larger the payout will be. The longer the person lives, the smaller the payout will be. So I hope this helped you with that section. And that is life insurance in a nutshell. Good luck studying. Let me know if you have any questions. Have a great day.